Hello and welcome to the Ask About Wealth podcast. This week I'm delighted to welcome back Aidan McLoughlin, who's been here before to talk about one of my favourite subjects, and that's pensions. And it's my favourite subject because pensions are so versatile. They can do an awful lot of things for you. Pensions allow you to accumulate wealth without paying tax. Pensions, if you're a business owner, allows you to use company money to do that and get a tax deduction from corporate taxes. Pensions allow you to stick money away in a lockbox that's not available to future creditors. Pensions are the Swiss Army knife of financial products. But like most tools, it's not buying the tool that's important. It's learning how to use that tool to your best possible advantage. And that's where I think the system is breaking down. A lot of the financial advisors involved in pension schemes that I'm aware of, and certainly through anecdotal evidence throughout my 40 years, they're more interested in selling the product than they are in helping the client use that product to their best possible advantage. Aidan McLoughlin, who's been here before, as I say, is certainly somebody who's taught me over the years how to use these products effectively and for the benefit of the client. So Aidan, thanks a lot for coming back.
Thanks, Paul. Delighted to be back and happy to chat to you again on the subject of the Swiss Army pension knife.
Well, that's great. Aidan, let's start with what happened since you were last here. So what has changed in the pensions market in the last 6 odd months or so?
There's been various events happening and will affect members of pension schemes and pension savers in different ways. One of the more recent things was on the 15th of August, the Revenue changed their pensions manual pretty much without warning to say no transfers out of pensions schemes after NRA.
NRA being normal retirement age.
Yeah. So in one sense it sounds strange. What does it mean? So if you take a defined benefit scheme, typically it's promising you a pension, but also when you come towards retirement, you get a retirement options letter which says you can take the pension and here's what it is, or you can transfer to an ARF or elsewhere. That suddenly disappears, and it disappeared for people that were in the process of actually transferring out, so it did cause quite a bit of angst in the marketplace. It's unclear what policy issue Revenue are implementing there. They did point out some restrictive legislation in the PRSA that seems to restricted for transfers to PRSAs, but they have gone ahead and applied it to all sorts of transfers in relation to that, and it's a real problem. And
So sorry, Aidan, for people on DB schemes, and there'll be a lot of those people, I hope, tuning in now, are you saying that there's less options today than there was on the 24th of August?
On the 15th, yeah, there is.
On the 15th of August.
There is, and it can disappear unbeknownst to you. You can be losing rights without knowing about it. And it's particularly problematic because the government is actually going in the opposite direction. There's legislation going through the Dáil at the moment to give you a right to continue to work after normal retirement age. And statistically anyway, there's a lot more evidence that people are continuing to work past normal retirement age. So what would have been a fairly unusual occurrence 20 years ago is now much more commonplace. So there'll be a vast number of people affected by this. They will think, since I'm not retiring at 60 or 65, whatever the stated normal retirement age is, I can just leave the benefit there and all my options will still be there when I come to actually retire. But that's not the case. There can be benefits disappearing because of this change. As I say, it wasn't a heralded change. There isn't a statement of policy attached to it or that they're being implemented. It seems to have been meant to implement a technical understanding of what the PRSA legislation says, but in practice it's a full statement. You cannot transfer out after normal.
So in terms of these are occupational schemes we're talking about here, isn't that right?
Correct.
Okay, so in terms of the listeners who are in occupational pension schemes, that's a scheme run by their employer generally that they've been a member of for a period of time. whether that scheme is defined benefit or defined contribution, the options post-NRA, normal retirement age, are far lesser now than they are pre-normal retirement age.
As based on what revenue you've put in the
Okay,
pension.
and that means that if you want those options, that you need to act before your normal retirement age, because
Correct.
those options are still open up to that date, yes?
Yes.
Okay. And those options include the ability to move to an ARF, which is very different than taking the pension promised benefit, because an ARF is your asset, whereas the promised benefit is payable for your life, maybe with a proportion payable to your spouse if you die first.
That's right. The scheme provides an income, the ARF provides you with an asset. That's a good distinction.
Okay. And then that asset within the ARF becomes more something you can influence more on the investment side. So you'll have all the various investment, broad investment opportunities that perhaps aren't offered, well, certainly aren't offered in the annuity, because then you're simply you're swapping your capital, aren't you, for a guaranteed income.
Correct. And also you have flexibility in the ARF about the amount of income you get, whereas the income you get is fixed once you...
Okay, so if I only need X rather than 2X, as long as it falls within the rules of the ARF, I can
vary it up
I
and
can
down.
lower my ongoing tax liabilities in
Yes.
that case by simply only taking the income I need rather than the income prescribed.
Yes, subject, of course, to the mandatory drawdown
Sure.
rules that exist for
Sure.
ARFs. But within the flexibility that's there, you have more flexibility with the ARF.
Okay, and it certainly would be my experience, and you can tell me whether it's yours, that those type of options are the broader scope of options are rarely discussed by the incumbent scheme advisor, because they tend to be shelling peas, don't they? Here's option one, here's option two, rather than here's all these other options that might be available to you.
Yeah, I mean, when you come to retirement, there's a statutory requirement that a certain amount of information is given to you, which is called your retirement options. There's a retirement options letter. It tends to be pretty formulaic. You can have a pension from us and this is what it's going to look like, or you could have an ARF option and here's what the transfer value might be if you want to look at that. But to tease out the structure of what you should have, the pension scheme isn't going to provide that advice to you. It's not your personal advisor. Typically, certainly with the schemes that we're involved as trustees on, we'd be encouraging you to get independent advice on this because it's a big decision. And not everybody gets it right, and that can be problematic. So again, it may be possible to have some guaranteed income and some ARF as well. It's not an either-or piece.
Right.
And that can be part of it. You could go to a PRSA instead of an ARF, and there could be advantages to that. Some people might be interested in transferring it overseas to somewhere like Malta, and there can be advantages in that. So there's a variety of options that should be considered by an individual at that stage.
And that are only considerable, if that's a word, by using an independent financial advisor. And I heard you'd say that there as trustees, and you with your trustee hat on, are trustee of many pension schemes here in Ireland and overseas, I think too. Is that right?
That's correct. Yeah.
Okay, so as the trustees, you're recommending that the members get independent advice.
It's important that they do so. We cannot give them the direction that they need on all aspects of it, because an independent advisor is going to look at all of their circumstances. So not just examining the scheme. The pension scheme is very important. It's got a chunk of assets there. But people will have assets
Spread
and
around
obligations outside of the pension scheme, and they need to be brought into consideration, and that dictates how they might deal with it. So we can see with our interaction with pension schemes some of the output from those advice we have. For example, in Malta we will meet people and they say, yeah, I'm not going to draw down on that because I have I'm continuing to work or I have income from elsewhere for a period of time. And that's good financial planning that an independent advisor has put in place with them. If we were trustees of the pension scheme that the benefit was accumulated in, we're not seeing that. We may not know of those extra income sources or the financial planning.
All the incumbent people are doing is looking at the scheme in isolation, as opposed to.
And that gives you a warped view of what's to the best interest of the individual.
That makes complete sense. So get independent financial advice, and based on the ruling in August change, get that independent financial advice before you hit your normal retirement age.
And a good period before, because the experience so far is individuals who had decided to transfer out but hadn't actually finalised the payment out before
they got caught by the rule change.
They got caught by this. So you need to not only know about the option, but have actioned the option and have completed the actions before you reach your normal retirement date.
Yeah, and one of the things you mentioned there, one of the options, and we did a short video on this recently ourselves, what is this switch to a PRSA? That you could take your occupational pension scheme prior to NRA, get your transfer value and switch this to a PRSA. What potentially are the benefits of that switch?
Well, the PRSA, one of the things that people can do, for example, is hold more than one PRSA. And that in turn will allow, when they come to access benefits, to phase the access to the benefit. So let's take a simple example. You have €1 million in pension benefit. You put it in two 500,000 PRSAs. When you access one PRSA, you get a lump sum on it at 25% of 500,000, and that's fine, it's 125,000. But you haven't triggered the second lump sum. The other 500,000 PRSA mightn't be accessed for another 5 years, or maybe 10. You could use it as phased retirement. By that stage, the fund will have grown and the element of the lump sum there will be greater. So you can satisfy current financial needs to have some capital injection and yet continue to get tax-free growth within a PRSA into the future and access a greater lump sum in the future for a further capital need at that time.
Yeah. So, yeah, I mean, it's tailoring, isn't it, in that sense? It's the standard system kind of leads all the sheep into one direction, if you like. Let's go here. Or maybe two directions, or for income. But if you broaden out your, if you seek out that impartial advice, then you'll see there's not just two exits here. There's 10 exits, 20 exits perhaps. And which one is for you, or which combination of ones are for you, is very much dependent on your circumstances rather than the scheme's rules.
That's right. And much of what we do, for example, when we're trustees in a scheme, we're very conscious. We're planning very much for what might be the average person. And by definition, the average person is in the middle between spectrums.
Yes.
And the ends of the spectrum aren't necessarily covered by it. So we will create, for example, a default investment option within the pension fund, which is attempting to say that on average, people will run to their normal retirement age and then retire at their normal retirement age. And if that's your characteristics, then this will suit you very well.
Yeah.
But if you're an individual that plans to actually retire before reaching normal retirement age or plans to work on after normal retirement age,
yes.
and that's going to become more of a thing for the future because the state is changing legislation to give you a right to continue beyond normal retirement age, then that standard default option is missing the mark by a little bit or a lot, depending on where you're going.
Yeah.
So it's the best we can do looking at you as a member of a cohort of 100
average.
or 1,000 people, an average.
Yeah.
But it's not customised to you. And therefore, Certainly in the early years it can be fine because, when you're 30, 35, it's going in the right direction.
Yes.
But as you get closer to retirement, 50, 55, you should be taking independent advice because that's when you start tailoring it. And the default investment option actually starts changing its mix as well. And that mix may be changing.
Which may or may not suit
Correct.
your short, medium, long-term plans for this. And of course, it's worth saying, isn't it, that certainly from statistics I've seen, people who have pension funds, the pension fund they have is generally speaking the second most valuable asset they have, the house being the first most valuable asset. So it's worth putting time and effort in here, isn't it?
It is indeed. Yeah, no, I was looking at some statistics. Now they're from 2020, but it gives you an idea of comparatives. I think with occupational pension schemes in 2020, the state was recognising about 120 billion in pension assets.
Wow.
In occupational schemes. At the same time, housing assets
in 2020
was about 500 billion.
Right. So 5 to 1, kind of.
And it emphasises that the bulk of the wealth, if you want to call it that people have to sustain them in retirement doesn't necessarily come from formal pension schemes.
Yes.
Now, as somebody immersed in the pensions industry, it's recognising you're not the be-all and end-all of somebody's finances.
Yes.
And when you get to the occupational scheme, that's important to recognise. What, as a trustee of a pension scheme you're looking at, is a portion of a picture. It's like peeping out through a window and being able to only see a portion of the house across the road.
Yeah.
You can get a wrong view of what's going on. You can you're apply as much knowledge as you have to try and get the best solution possible. But the individual must act themselves to get their own impartial advice at appropriate times to make sure that it's tweaked fully, because the system is flexible enough to be tweaked.
Yes.
But they have to know how to tweak it.
You have to know what buttons to press.
Exactly.
Yeah. I mean, it's interesting you say about the averaging, and I talk about averaging too in my consults, but, just thinking about what you were saying there, if you have a scheme that has a range of 20 or, from 20-year-old to 60-year-old, and let's say that there's an even spread there, and the scheme is being managed for the average, the scheme is being managed for the 40-year-old in that example. And if you are ever average in that scheme, you're average for a nanosecond, aren't you? Before that average, the scheme is being managed towards the average, but you're not yet average.
Yeah, it's not quite as bad as that
Okay.
nowadays. The default investment option tends to have, it's a moving piece. So it starts you in high risk assets in your younger years, because for a couple of reasons that makes enormous sense. You have such a long period of time to go, so they're
to earn
higher
out
growth,
the
higher risk, so
highs
the
and
ups and
lows,
downs don't bother you. But also your capital fund accumulated is lower, so that if you put in €100 and it falls by 50%, you've lost €50. But if it grows by 50% a year later, you now might have €500 in it, so you gain 500 having lost 100. When that becomes an accumulated fund of $1 million, the fall of 50% is a bigger hit relative to the level of flow
damaging.
in. So younger people always should have higher growth, higher risk, higher growth assets. But that should peel down, and that's what default investment strategies look to do at this stage. It's a lifestyling element.
Yeah.
But even at that, it's still imperfect.
Of course
it's
it is.
suited to the average person, as you say, but it is the average 40-year-old or the average 50-year-old. But even within that, their circumstances are different.
Yeah.
Some people, this might be the only income they have for the rest of their life, so it's very important to them. Others may have income independently from both their employment and the pension scheme, or indeed they may have within the family, for example, a well-pensioned spouse that means that it takes the pressure off this scheme. None of those factors
are taken into account
by the trustees. They can't. They don't have that and don't want that. But it's for the member to take into account. So
don't have it, don't want it, and not their job.
Not their job, yeah.
So, very good. So, that's what's changed. I'm going to ask you to get out your crystal ball now for a second and tell me what's coming down the track in this space, as far as you know.
Well, it's interesting. The Pensions Authority is engaged in consultation on a couple of topics, but one of the first one coming to a head is in relation to the investment allowed by PRSAs. What they have issued is a consultation paper, and they have said, occupational pension schemes are subject to various restrictions on how they invest. They have to invest primarily in liquid investments on regulated markets, by which typically means stock exchanges and stocks and shares and whatnot, and bonds and that. And they say, why shouldn't we apply the same rules to PRSAs? Now, the problem with that is that it's confusing what PRSAs are, and indeed the PRSA itself is a bit confused, because there's two types of PRSA. There's a standard PRSA and a non-standard PRSA. And a standard PRSA is intended as something that's provided to employees in employment, and therefore it is equivalent to an occupational scheme, and arguably therefore should have the same rules as that. But because it's already restricted to investing in pooled investments, the industry would say, effectively, it's already restricted.
Inside the fence,
so you don't need to change the rules.
Okay.
On the non-standard PRSA, it's treated as being the personal assets of the individual. Much more freedom is provided to how those are invested, intended to reflect how the individual would invest if they weren't within a pension. And part of that is that it's saying make it to as attractive as possible because it's voluntary. So do what you normally invest in, but we're going to ask you to restrict your access of it till you're beyond the age of 60. That's the trade-off that's there. We'll
so the standard PRSA, designed for people in occupations, as it were, has an access age of 50
on early
retirement with employer approval. Is it with employer approval?
Well, you've left service to get.
You would have to have left service, okay. And the non-standard PRSA has a normal access age from 60.
Correct.
Okay. But that non-standard comes with much broader investment options.
Yes.
Okay. So property is one thing that our clients are always asking us about. And property and pensions is something I've certainly been, a flag waver for because of the rules. Can you tell us the rules as they exist on that side in property and pensions? And can you tell us what, and I know, as I said, I know I'm asking you to look into a crystal ball, but this review that's going on, best guess, what do you think is going to happen on the property inside pensions front?
So property inside pensions is a popular investment, as it is outside of pensions. Again, it's reflecting the characteristics of investors. Mm-hmm. And it's worth noting, and the Pensions Authority itself notes, that in the last few years, the number of non-standard PRSAs have mushroomed relative to standard PRSAs. 2/3 of all PRSAs are now non-standard. So insofar as investors are voting with their money, they're voting for the non-standard.
For the more flexible.
So the move by the regulator isn't something to meet consumer demand. It's to restrict the consumer, presumably in what the Pensions Authority would perceive as their best interest. They shouldn't really be allowed to invest in that. The difficulty with what they're proposing is that would, in the case of property, go contrary to the policy and objectives the government itself has.
Here we go again. We've got two different arms of the state arguing opposite sides of the coin.
Well, the housing policy from the government has been launched today, so they're looking at how they can provide more monies into housing, particularly social housing. Many of the properties held within pension funds are utilised for social housing. They're rented to local authorities, etc., for that purpose. So you're going to cut off a source of supply in a market that you're acknowledging is short of supply. That doesn't make sense overall, but it being considered in some narrower focus on it. The second thing you would say is, why do people like property as an investment? And if you think about it, it's with the one area of investment that they have spent a certain amount of time studying. Throughout their lives, they have looked at the property market as tenants, as property purchasers. They understand the characteristics of it, the different areas of the country and how it will behave, etc. So it is an area of investment that they're extremely skilled in.
And comfortable with.
They haven't spent a lot of time, perhaps very few people would have, in looking at some of the areas of the stock market that they could invest in. And therefore they have less comfort for it. So it's a very natural, logical thing for people to do, is to rely on the areas that they have knowledge of and can form their own view on. The other thing that brings is you don't get a reaction when there's a correction in the market. The problem with investing in the stock market is a lot of people that are unfamiliar with it can panic when it falls by, say, 20% and jump out of the market, thereby crystallising the loss. It was only a notional loss up to that, but now it's crystallised. They don't tend to do that in property. When the property turndown occurred with the financial crisis back in 2008, people weren't selling because of panic. They were forced sellers, perhaps
by the banks.
But they weren't selling because they were panicking the market. And indeed, the rental income didn't fall by 50% of capital value. The rental income held up. So those holding it for the longer term were happy to continue holding it, but for, as you say, the reaction of the bank. So it's a very important asset for the individuals who are investing in it. It's something that encourages them to invest, and it encourages them to invest more, in our experience, because you need significant funds in a pension fund to be able to afford to buy a property. Yeah. So all that is positive for the objective of getting people to save and to consider it over the longer term. It's equally in tune with the overall objective of the state vis-a-vis housing, to make more housing available and rental housing available, etc. So all those objectives are being ticked by the current environment. Now you look at what happens if the Pensions Authority is successful and it restricts access to property investment and pension funds. Clearly, fewer people will invest in property through pension funds. That means a second cohort is going to say, well, to hell with pension funds, I'll invest in property outside pension funds. So they'll do their retirement planning outside orthodox pension structures. Now, a state might say, well, we don't care how you save for retirement as long as you're saving. But no statistics really are tracked on that. The state doesn't regard that as retirement planning. So it suggests people are under-provided for. They'll be forced into auto-enrolment because they don't have pension saving when they have actually got pension saving in the broad sense, retirement planning, but they've done it through property investments. So the very success that the PRSA is currently enjoying in terms of the growth and its use is linked to its ability to access assets such as property, etc., where people can feel comfortable with investment.
And what would be, in your view, what would be the reason why this restriction is being considered? I mean, it doesn't seem to make any sense.
The Pensions Authority is primarily, the bulk of the assets it regulates at the moment are occupational pension schemes. And under a classification system that the EU uses, the Irish state uses, developed by the World Bank, the pensions are divided into different pillars. So pillar 1 is what the state provides through social welfare. Pillar 2 includes occupational pension schemes, which is effectively a system provided involving employers in funding it. It's not just funded by yourself. And then pillar 3 is voluntary savings. What's happening here is they're confusing pillar 2 and pillar 3, two completely different markets. One is where large funds are being managed on behalf of third parties. It's right and proper that certain prudential rules apply to that. On the other hand, over here in voluntary savings, you have people managing their own money. And that should have, by definition, a different set of characteristics to it. But I mentioned at the start, the PRSA has this dual nature. You have the standard and non-standard PRSA. And what's being confused is the standard PRSA is a Pillar 2 product and therefore should have rules, and actually does have rules that does that. So it doesn't need new rules to implement it. Whereas the non-standard PRSA is for voluntary savings, and it's to encourage people and attract them in and to do the type of investments they would do anyway. It's dragging the state into, if the rule did come in, it would drag the state into the funny situation of saying, look, we don't think you should invest in property in your pension fund. Oh, by the way, you're free to invest in property outside of your pension fund. So it's not really a consumer protection mechanism.
Yeah.
It can at best be probably viewed as, do you know what, as a regulator, life might be a bit easier if property wasn't there, because it's much easier and we're more used to dealing with pooled funds and how they operate. That's the typical.
And has there been any, in terms of history, has there been any kind of dramatic failures in the less regulated, non-standard world that might cause the Pensions Authority to go, maybe we need to put a few more rules around this thing?
So we have a full spectrum of investments. People can go further up the risk profile, and therefore you have investment specific risk. So if you go into a single investment, it can fail.
Sure.
In a property, the classic example would be probably if it burned down and you didn't have insurance on it, you have an entire failure on it. In the financial crisis, you had the debt exposure causing the property investment to fail because the bank forced a sale at a time the prices were depressed and effectively the equity were
the banks looked after themselves.
So investments can fail on that basis, and that can appear riskier. But using the financial crisis as an example, at that time, the statistics were published that Irish pension funds had lost more than any other pension fund in Europe because they had a heavier concentration in equities.
Equities. Okay,
yeah. And the view at the time from the regulator was, well, that's inappropriate. You should be more in bonds. And therefore, trustees, being good and obedient citizens, moved the assets more into bonds.
Yeah.
And therefore, those pension funds all missed out on the growth in equities that occurred after that, the bounce that occurred afterwards. Whether the philosophy was right or not, it was actually the regulator that had panicked, if you like, in a crisis, arguably, rather than the individual investors. Because the thing to do was to stick with the investment philosophy and ride it out. The cost to pension funds probably runs into the billions in relation to that. So in relation to the role that a regulator plays on different aspects of the pensions market, it should be different. With the occupational schemes, there's a logic to why somebody managing money for others should be adopting the prudential rules. On the other hand,
if you're managing your own money,
money, you have a choice of investing inside pension, outside a pension. If you're going to regulate it, in care for the consumer, you should regulate it
equally on both sides.
So if you think something is too dangerous to be anywhere near an ordinary investor, then whether it's in pension or out of pension, that should be regulated out of existence.
Yeah, we did recently. We were talking about I think it was the PRSA or maybe some other government body said that Irish household wealth had just surpassed 1.2 trillion euro, and that 67% of that is property.
It is, and you can see that from the statistics I had from.
So, as you say, Ireland Inc. Our investors and non-investors, homeowners, are already heavily exposed to property in their personal lives. Restricting them in their pension lives seems, dare I say it, ludicrous. But do you think this is going to happen?
It is difficult to be certain on this. It depends at what level policy is being implemented. If you look at what the government is trying to do, it clearly is trying to make things more flexible and encourage more people in. If it's been done at an administrative policy level, it possibly could make life easier for regulators and the departments involved. But it's very difficult to judge it. I think anybody that feels strongly about it should probably make a submission on it. The closing date for submissions is the 17th, so there's still time to share your views and hopefully
and have you made a submission on it?
We have, yes. We are making a submission. I'm not sure if it's actually gone in yet, but we will be making a submission.
And your submission favours status quo rather than make the change, I presume.
Correct. The only thing we would say is if there's a specific category of investments that concern you, let's take, for example, something that's very popular, cryptocurrencies. If there's aspects of cryptocurrencies that would cause you concern for consumers generally, then look to deal with that. But of course, one of the problems that exist with policy statements like that is that the fractured nature of how policy exists. There's a variety of people involved in regulating pensions. So the Pension Authority has a role in pensions, but the revenue have a role in pensions. The central bank have a role in pensions. So at what level does that policy come in if you're doing it at administration level, and therefore the extent to which it has? So take in pensions. The Pensions Authority regulates occupational schemes and PRSAs. It doesn't regulate buyout bonds and it doesn't regulate ours. That's
somebody else's job.
Just a fractured nature of...
So I suppose in terms of buying a property in your pension, it's possible today.
Yes.
It's possible with debt.
Yes.
And that I think you told me before we started recording that debt typically limited on the on residential property anyway to 50% loan to value.
Yes.
But that debt is non-recourse. So it's safer to borrow money inside your retirement fund for a property than it is to borrow money outside.
That's correct.
So the argument to the reviewers here is that you're letting people, you know, in their personal life, borrow money, buy property, put their own home at risk, put their car at risk, put their pension fund at risk, or certainly the income derived from that pension fund at risk. But you might want to stop them doing that where the risk is lower. That makes no bloody sense at all.
Again, you're taking a correct helicopter view, whereas because of the fractured nature of the regulation...
They're looking at one piece, as you say, through the pinhole.
Through the pinhole. That's part
for goodness sake, stick your finger through the pinhole, regulators and advisors, and have a look. So I suppose, sorry to cut across you, Aidan, but if you're interested in doing property in your pension, the sooner the better, by the sounds of it.
Yes, this is a consultation. There's no guarantee that
anything will
happen. And even if it does happen, there will be time needed to implement it. But if it is something you're looking at, sooner rather than later is better. There is an indication in the consultation that it would be prospectively applied, which means that from now on...
Yes, it wouldn't be retrospectively.
It wouldn't require people that held property to have to sell the property, etc. They could continue to hold it. But what would happen is if they had planned to sell this unit and buy a different unit, they would be restricted that in the future if it happened. Okay,
and before we started to record here, we were talking about this, and you told me that not only would this be a retrograde step, but that other markets are going in the opposite direction. Isn't that right? In terms, you mentioned US markets, for example, and UK markets. What's happening there?
The nearest equivalent in the US to the PRSA would be something called a Section 401k.
Yes.
It's a personal asset saving vehicle that you control the assets in, and it's voluntary. And in that case, they have literally in the last month expanded the range of investments that you can invest in to be able to invest in more illiquid assets, private equity, etc., digital assets, to expand the range of investment opportunities that's available to people in that. In the UK, the top 20 pension funds came together with the government, with the encouragement of the government, into what's known as a Mansion House Agreement, whereby they committed to putting more money into alternative assets, specifically unquoted equities in the UK.
Private equity.
So getting more money into the local market, into the alternative investments, is an objective of the UK government and of the larger pension funds there. The EU is trying to encourage that as well, with its Capital Markets Union and with other initiatives that it has. It's looking to get more money into local assets, illiquid assets, infrastructure, and private equity. One of the things that the effect of the proposal from the Pension Authority would be even less money from Irish pension funds would be invested in Ireland. If you go into liquid markets, you end up going into the world of stock markets, of which Ireland makes up a fraction of 1%.
Yes.
So there's very little of the money invested locally. Obviously, people investing in Irish residential property have a good chunk locally, which drives on the economy.
Yes.
To use that in a different context, when looking at auto-enrolment, a lot of people point as an example to the Australians who brought it in 20, 25 years ago. But what isn't often focused on is all that money that flowed into auto-enrolment funds in Australia were invested back into the Australian economy. So they drove the economy. So over 50% of all superannuation funds assets in Australia are in the Australian market. And the only reason it's falling to 50% and lower is they're running out of assets in Australia to invest in. The funds there are now into the trillions of dollars.
Yeah.
And the stock exchange, for example, isn't big enough in Australia to take it. But Australia, as you know, has enjoyed a boom, an economic boom for a quarter of a century or more. And part of that is down to the virtuous circle of the money being invested locally. Whereas, in fact, everything invested in occupational schemes in Ireland pushes the money out of Ireland. It helps the French and German governments because a big investment asset is the French bonds and the German bonds, but it's not necessarily doing much.
So I mean, the law is an ass at times, unfortunately. And I mean, but I do. You said it earlier, and I have to agree with you. For the most part, regulation is well-meaning. You know, they're not putting out. You know, they're not changing regulation for any other reason than to benefit the consumer, let's say, or for the most part. Although what you said sounds like that the Pensions Authority might be considering change to benefit itself, and that wouldn't surprise me. But there you go, that's just me. But earlier too, you were saying that if this happened and they drove us out of property and drove us into the more liquid markets, as you say, and you were telling me about the ETF market, for example, and the global ETF, and it being hugely exposed to America and hugely exposed to the Magnificent Seven. Tell our listeners that.
So if you go for, say, a world equity ETF, an exchange-traded fund, which attempts to effectively mirror the world stock market, about 60% of that will be in the US as of today, because that's the scale of the US stock market. But within that, about 20% of the US stock market is in this Magnificent Seven, which are all highly inflated stocks linked to the AI boom. Mm-hmm. And some would say the AI bubble, in that if that reverses in any way, there's a huge negative impact. So you could have the strange scenario where the effect of these rule changes would swing pension fund investment out of Irish residential property, which for all characteristics would suggest it's a reasonably stable and reliable income generating asset for at least the next 10 or 15 years. There's no suggestion of surplus in that particular market.
Definitely not.
Into a market that may be close to a bubble.
Well, certainly is at its heights in that respect. You know, we're talking about heights of stock market valuations, aren't we, that are
Correct.
Historically greater than they've ever been.
Yes.
Yeah, very interesting, Aidan. I mean, you mentioned there briefly, and before I let you go, I have to ask you about it again, and that's the whole auto-enrolment thing. And I was telling you before we started recording that I was rushing to get a personal contribution through payroll, even though I have a retirement scheme funded by the company. But that I was looking at this, well, if it doesn't go through payroll. But it isn't about going through payroll, sure it isn't. It's about being recognised on payroll.
Yes, so the the purpose of auto-enrolment is to haul people into the system unless they have pension structures already in place.
Yes.
The way in which the state is doing it is they're looking at the payroll records for September, October and November
2025
to see if evidence exists that a pension exists for that person.
Right.
It doesn't matter the quantum of the pension, just anything on it. In theory, if €1 is going into a pension, either by the employer or the employee, that's enough, because as long as that's recorded on the payroll system, they can recognise it. So this is a very much a computer-driven exercise. There's nobody going to be flipping through paper records to pick this out. The computer's going to pick it out.
And say, there's none here.
No
Boop,
contribution.
boop, boop.
Come 1
In.
January, we're going to start taking money out through the payroll system.
Okay.
for you.
So, as you said to me earlier, make sure if you have a pension scheme, and this would be, I suppose, particularly for business owners, if you have a pension scheme that's solely funded by your company, which is my pension scheme, make sure that is recorded on the payroll on or before the 30th of November.
Correct. Or if you have a scheme, for example, where you just do one contribution a year in late December, it's not going to be on the payroll in November.
No.
So you have to bring that
November is the dedeadline there.
November is the deadline.
Otherwise, we're going to get dragged in. Now, we can opt out 6 months later, from what I understand. But
yes, but you can't get the employer contribution back.
Does the employer get the contribution back?
No. It stays there.
So it's,
you get your personal.
You get dragged in. You get the 1%. You pay the 1%. Your employer pays the 1%. You at 6 months' time, you opt out. You get your 1% back.
Yes.
But the employer doesn't get their 1%, and the 1/3 that the state added
stays there.
Stays in the fund.
Yeah. So you still have an auto-enrolment pension, which you can't transfer out or do anything with. So you have a fraction of a benefit.
Exactly. The other thing is, and I've said it before, and I think you'll agree with me, I'm right in saying, that from a tax relief point of view, the current pensions give a better tax deduction for high rate taxpayers, while the new auto-enrolment gives a better tax benefit to low-rate taxpayers.
That's the intention, yeah. It's specifically targeted at the non-taxpayer or the low taxpayer.
So for high-rate taxpayers, make sure you're in the current version, not the auto-enrolled version.
Yeah.
Aidan, thank you very much again for coming in. No doubt we'll have you back. If I can summarise in terms of just talking to the audience directly for a minute, what I hope you got from this, if you're a member of a major occupational pension scheme, prior to reaching normal retirement age, you need impartial advice. The advice that will come at you through the incumbent broker will predominantly be advice around the scheme rules, not the all options. That'll cost you a few bob, because those impartial advisors, generally speaking, are fee-based, but it's a few bob well spent in my view. Thanks for listening, and Aidan, thanks for coming along today.
Not at all. Thank you, Paul.